On today's Hot Sheet, I discuss housing inventory, affordability, and the lock-in effect, as well as the future of San Francisco. Today is Monday, July 17th, 2023. I'm Byron Lazine, and the Hot Sheet starts now. Good morning. Welcome back to the Hot Sheet. If you are a returning viewer to the stream, good morning, Jeremy from beautiful Austin, which I'm looking forward to visiting in September. If you don't know what that's about, I don't know if we've got a link for that, but I'll be at Jeremy's event in September. Maybe we can put a link up for that. Good morning in Phoenix, Emily. Let me know as you guys are jumping in which market you are tuning in live from, especially if you are new to the Hot Sheet. That is how we roll here. Good morning, Mike in Atlanta. Let's take a look on this beautiful Monday, as we always do, at the inventory and overall market update. Okay, according to Housing Wire, weekly active listings officially rose after 2 weeks of declines by 5,569. Actually, we did have I take that back. We did have an increase last week. It was just far lower than what we typically will hit this time of year. And we're continuing to have this really slow crawl or non-existent crawl on active listings at a time of year when we expect active listings to be growing, when we expect to be accumulating inventory. So we went up 5,569. To put that into percentages, okay, as of July 14th, inventory was up was up, where is that number? Had it. I don't have it. Okay. But I'll give you some percentages on year to date. Inventory year to date down 4.1%, usually up this time of year. Inventory is up 16% from the seasonal bottom, which was 13 weeks ago. Okay, so let's take a look at some of the charts. I get a whole bunch of good charts here today for the Hot Sheet. You've got to be a BAMX member to get the daily download. So one click. Actually, I've got a code, right, Bobby? We did a coupon code. So we're going to run this until the FOMC meeting next week in honor of Jerome Powell. You can use code Jerome to get 10% off of BAMX down below. You get your daily download from the Hot Sheet every single day, as well as all of our live streams and our courses and our private Facebook group. You get discount to our events. We've got one coming up in late September as well that we'll be announcing soon. Okay, weekly inventory here did rise from the 464,000 to 470,000 range. Same week last year. Look at that. Same week last year, we jumped up 21,000 on the active listing count in the same week last year, from 487,000 to 508,000 plus. So we're well off of last year's pace. Interest rates this time last year were lower than they are right now. The inventory bottom for 2022 was 240,000. The inventory peak for 2023, 472,000 plus. And in 2015, we were at about 1.2 on the active listing. That'll be available for you in the daily download. You can see inventory now for the last 3 weeks has crossed under levels of 2022, still above 2021. And new listings for 12 months has been the lowest ever recorded and continues to actually go in a downward trend. New listings for the weekly data, 57,000 and change, where in 2022 we were up over 72,000, 2021 83,000. Calculated risk put together some Altos research into one chart going all the way back to 2015, so really putting into perspective where we're at. According to this Altos research from Calculated Risk, they have us at 7% in the negative year over year on active inventory. Where was that number I just read? That was 4.1. I want to get an accurate number. Hold on. Year-to-date inventory down 4.1. They have on the chart here 7.5 year over year on active inventory. Let's just make sure that that's still active inventory. It is 7.5 and 4.1. That's from the same source, by the way. Calculated risk using Alto. So not sure what the heck they did there. Inventory was down 7.5% compared in the same week in 2022. Okay, so that's inventory down 7.5% same week. 4.1% is year to date, January 1 to today. The 7.5% number is year over year. Okay, so that's where we're at year over year. We're down 7.5%, 4.1% down year to date. And we're down over 50% on inventory from 2019. That really puts into context how far we have fallen on the inventory struggle. And I've got an update here a little bit. Yeah, we'll get into it right now. We'll get into the affordability issue right now and why we're experiencing this. There's one reason, that's the inventory, but this is really due to one factor, right? If we really boil everything down, we can boil it down to this. And this pie chart is fascinating. If you want to grab it in BAMX, of course, use the code Jerome, whether you're doing monthly or annual, to get 10% off of your subscription. You get 10% off the first month or 10% off your entire annual subscription to BAMX. This chart's fascinating. More outstanding mortgages have a rate below 6%, says Morningstar's. In fact, it's 9% of outstanding mortgages are have a interest rate at 5.01% or more. You can see 5.01% to 6 is 5.3% of all outstanding mortgages, and then greater than 6% is only 3.7% of outstanding mortgages. So that's 9% total that are essentially over 5% on the mortgage interest rate. When you have 91% of outstanding mortgages at 5% or lower, it's going to create an environment where people don't want to put their house on sale and trade into a higher interest rate. And it's also going to create an environment when you're sitting up over 7%, like we are, where a lot of buyers are just a little bit more hesitant or simply can't afford. So this is the effect of an outrageous money printing machine that Jerome Powell went on in the last couple of years. They went overboard with that last $2 trillion spend, which I don't know if we've seen any of the benefits of that last bill. It certainly put us into transitory inflation times, which have proven to be, I guess, now people are running around saying it's transitory, but it was only transitory or stopped being transitory when you went on the most aggressive federal rate hike of all time, which we've experienced and we're still due to experience, right? Next week, there's a 93% chance that investors are projecting a 93% chance that the FOMC is going to go ahead and raise the federal interest rate again. So these aggressive rate hikes have caused the mortgage interest rate to sit up over 7%, albeit the spread is abnormal between the 30-year and the 10-year. That has a lot to do with the bank crisis that we saw earlier in this year. There was a lot of projections earlier in the year that the 30-year would start to get to a more normal spread between the 30 and the 10-year. That hasn't happened yet. There's still projections that will end the year closer to 6, maybe even high 5s. Next year, we have most projections coming in between 5 and 6% on the 30-year. So hopefully the future looks brighter if we can get to sub 6%. My thing is, if we can get to 5.5%, then we're at least, now listen, again, only 9% of people have an interest rate over 5%. So if only 9% are there, I'm like kind of stretching here, but I think that this category right here, this 4.01%, basically over 4%, could then convince themselves to trade up. Okay, so if you're over 4%, you got 20% there plus the 9%. So you got almost 30% of outstanding mortgages that have an interest rate over 4%. So if rates are at 5.5%, to me, you could get you could get somebody at 4 to say, "I'll trade into this for the right home." Meaning I'll list my house, I'll put it on the market to get the right home, and I'll go up a point, I'll go up a point and a half on my interest rate. I'm not going to go I'm not going to go from 4 to 7%, which is basically where folks have been getting quoted in at the last, 4 or so weeks. Going 4 to 7% is a lot to stomach, right? Especially if you want a new house, you can see that you need a new house, but you know what? My kids can share a bedroom here for another year, another 2 years, and we'll just see what happens. We don't have to move. All right. We have the best hedge against inflation by sitting on this 4% interest rate. And then, of course, people that are less than 3% or 3 to 4% on their interest rate, they have even a better hedge against inflation. I made the argument to Phil Jones the other day that they're printing money. He's like, well, they're not printing money. They're just, they're just lowering overhead. Well, this is the homeowner's example of printing money. I'm sorry. This is how they print money in an environment where, you only had a moment in time to grab 2%, 3% mortgage interest rate. Now that we're in a 6, 7% world, 7% plus, they're basically printing money compared to people who are buying a home today. They just are. They don't have the machine that Jerome has. Coupon code Jerome down below for BMX, but this is their version of the money printing machine. All right, so there you go on affordability. There's a piece in Fortune on that today, and it's really it's to me the biggest takeaway was that mortgage pie chart. Moody's Analytics chief economist Mark Zandi, he holds a different view. He anticipates housing affordability will improve over the next few years as mortgage rates slowly drift to from around 6.5 to 5.5 in 2025. So my goal and number of 5.5, I want to see happen in 2024. I want to see happen spring market 2024, get a robust market. He sees it in 2025. He believes that national home prices will ultimately fall around 8% from peak to trough. In other words, Andy expects strained affordability to overcome the lack of inventory, and he thinks that home prices falling are going to be a part of that. Show me how. Show me how home prices fall when we don't have any active listings coming onto the market, right? We don't have new listings. We don't have new inventory, and we still have demand soaking up the inventory that is hitting the market. In our thinking, this weakness plays out over the next 3 years. There's no cliff event here. No kidding, Zandy. It's more of a slow grind lower. So he thinks slowly over the next 3 years, prices slowly grind down to a lower point, as well as the interest rate. And those two alongside each other create more affordability. Lenny, back from the gym. Hey, professional salespeople, I know this isn't the show for this, but professional salespeople hit the gym each and every day. That's how you keep your mind clear out there in California. Love that you're hitting the gym early. Code Jerome. You can't forget code Jerome. Go grab your spot in BMX. I'm doing a live stream mastermind next week, 26th, on online leads, Zillow being a big part of that, and other online leads. So if you're looking to learn more about online leads, need a new lead pillar in your business, make sure you get in there now. We have a new course. We have a course up right now on that. We have a whole bunch. I mean, the amount of content in BMX is incredible. We're not ripping you off like legacy real estate media companies. We're actually providing way more value at an affordable price because we believe that you should become a better agent, sell more homes. And you're not going to do that if you're getting ripped off and getting weak information. But going back to Zandy, if by any chance Zandy's team is mistaken, prices end up being stronger than anticipated, which I think is a high scenario, high likelihood. He asserts that it would be due to the prevailing Lockin Effect. This Lockin Effect, which I called 18 months ago the Cold War, where buyers and sellers kind of play this stalemate, mostly where sellers just kind of sit on their hands and don't do anything, don't put their house on the market. Lockin Effect is what a lot of people have referred to it. I don't think people like the Cold War analogy. I don't think they like the terminology I've used. But I'm going to keep going with it. But Lockin Effect is what many have used. I'm fine with that as well. The Lockin Effect, individuals choose to hunker down, and the shortage of inventory continues to drive national house prices upward. Okay. Certainly could happen. I could see segments of the housing market, maybe luxury, getting restrained and moving downward. But when we're talking about average price points and median price points, those are the ones that I think are going to still have pressure upwards, because that's where the majority of the demand is. The majority of the concerns, when we look across America at our great cities, would be in San Francisco. San Francisco primarily for a variety of reasons the last decade. There's a piece in Bloomberg this morning. It asks the question, or doesn't ask the question, makes the statement rather, that San Francisco is not destined to be the next Detroit. The city by the bay is in a downward spiral, but it also has a mean to get out. So Bloomberg piece by Justin Fox is saying that San Francisco is not the next Detroit. Headline caught me because it made me think back. Yeah, Detroit was America's most powerful city at one time. Detroit was where everybody wanted to be, and now it's seemingly where nobody wants to be. San Francisco has been having a tough decade so far. He opens the piece up. As of a year ago, the most recent numbers available from the Census Bureau is that San Francisco's population is down 7.5% from April 2020. That's a pretty large exodus in a 3-year period. It's the sharpest drop of any U.S. city over that period. Downtown activity is measured from mobile phone use. How do they get the measurement of our mobile phone use? But downtown activity measured from mobile phone use was 68% below pre-pandemic levels as of this spring. Again, the biggest decline among American cities. So they have your mobile phone use apparently in every city. Downtown commercial real estate values have fallen by as much as 80%. We've talked about that a bunch here on the hot sheet, where people are just, commercial building owners are just turning their keys over in San Francisco, walking away from debt with the banks. Owners of several big properties simply walking away rather than continuing with loan payments. So all of those, when you think about all of that, you think about the ongoing issues that San Francisco is having with other things not mentioned here, like crime and homelessness certainly being a factor for people leaving. You could start to envision a scenario where San Francisco becomes the next Detroit. Back when Detroit was like America's city, it's when we were building all those cars and in that thriving economy. San Francisco became a thriving city because of tech, right? Now you can really build a tech company from almost anywhere, and people are doing that. They're moving tech companies all over the country, whether it be Austin, Texas, or Miami, Florida. With the city, San Francisco in particular, or at least some of the areas near downtown, also becoming disorderly with this crime, it's probably inevitable that people have begun labeling San Francisco the next Detroit. Detroit is the case study in American urban decline, losing population every decade since 1950. A lot of Californians in particular will encourage you not to worry about their population decline overall as a state, or in places like San Francisco and LA. They say, well, it's just the last 5-10 years that we've seen this. And really, they'll say, a lot of agents will say, this is a good thing because we have a shortage of housing inventory. So if you don't like it here, get out. I've heard that a lot, where agents have had this, this not arrogance, but this pride of being a Californian. And if you don't like it here, get out. And you don't want to say that too long. Maybe that's a nice statement to say for a year or two. You don't want to be caught in that pickle decade after decade like Detroit has had, where they've lost population every decade since 1950 and are nowhere near anywhere that they used to be. So could history repeat itself? Justin Fox from Fortune says the simple answer, or from Bloomberg rather, says the simple answer is no. No, history never repeats itself exactly. And in this case, many of the particulars don't match. San Francisco was an iconic, important city long before the tech boom. Think, this is not in the piece, but think Full House, right? If you were from the Full House days, how iconic was San Francisco back then? It transformed and tested it over the past quarter century, not a place defined by its dominant industry as Detroit was and still is. Its physical reality is one of not post-industrial grit, but some of the world's most spectacular urban scenery. San Francisco does have beautiful scenery. I know that driving through San Francisco, going to Napa. Its crime problems are real, but generally not deadly. I mean, listen, you got to get it under control. I'm not a crime expert here, but by just that's kind of like a statement in this piece. And of course, it's an opinion piece. I've got some charts here, which we're gonna get into the facts of if San Francisco could become the next Detroit. But just waving crime off as not deadly but real. Well, could it get worse? I don't know. Yeah, I mean, certainly it could. States here that the homicide rate remains on the low end for a large American city, and the racial dynamics at the heart of so many of Detroit's ills are, well, certainly not San Francisco's racial dynamics. I would say that San Francisco has other dynamics holding it back, which would be, drug use and homelessness and a real like elitist class versus a poverty class, and so not mentioned here, but I guess I'll just throw that in just from observation. Still, San Francisco truly in a crisis right now, and Detroit really was top of the heap 75 years ago. Several more parallels jumped out as I read New York University historian Tom Suguru's 1996 classic, The Origins of Urban Crisis. Don't know if I got Tom's last name there right. Once freewheeling, startup-driven industry maturing, consolidate, and disappearing its jobs around the country and world. So, could San Francisco lose jobs around the country or even around the world? Certainly can in this environment where many folks are working from home and they can live anywhere. Look at Elon's Twitter not paying rent in their San Francisco office building still to this day since he took over. And eventually you can imagine he's going to move out of there entirely. David says, there's definitely an exodus of people fleeing that city. I wouldn't write off the incoming AI tech boom there. Certainly not. I wouldn't write off AI tech at all. I mean, that's certainly coming. Question is, will these, in a lot of the Silicon Valley, San Francisco companies are investing and starting some of these AI companies. Will they need to employ everybody there? Will they need to be in office as they were when they were building, say, a Facebook or Google, or will they be scattered in different places? That kind of remains to be seen. There has been a trend there of a lot of companies going more remote status. In the 1950 U.S. Census, Detroit's population hit a record 1.85 million, up 14% from a decade earlier. So they were adding population. When they got to their peak, they had years prior of people migrating into the city. Look at the places now that are adding population. Are they going to be the power locations of tomorrow? History certainly tells us that they could be. Okay, Detroit was the country's 5th largest city. The census takers also found Detroit's median household income for previous year to be the highest of any large U.S. city, and that of its 3-county metropolitan area to be among the largest metro areas. So let's take a look at some of the data here. Going back to America's most affluent metro population areas in 1949. I put these down below, especially if you're in one of these cities. One of these two charts from Bloomberg might be relevant for you in a newsletter piece. If I was in San Francisco, I would certainly make the case that Bloomberg is making, that San Francisco is not going to be the next Detroit, and here's why. Okay, so 1949, you see both Detroit and San Francisco on the list. So certainly Justin Fox is right about that San Francisco has been a prominent and iconic U.S. city for long periods of time. But back in 1949, Detroit, Michigan, had the highest income earning potential, higher than Cleveland, which was up there. And think about that. Cleveland certainly wouldn't be up there today, but we'll look on the second chart. Milwaukee, Chicago, Toledo, Dayton, and Akron. Wow, Ohio was really dominant back in the 40s, huh? Ohio seems like the place to be. San Francisco, New York, Hartford, Connecticut, Youngstown, Ohio, again, Ohio, Rochester, Buffalo, Columbus, Ohio, and then Washington, D.C. That's where you could make the most. Those were America's most affluent metropolitan areas in 1949. Ohio was just dominant in the 40s. That's the place to be, is what I'm getting from this chart. America's most affluent metropolitan areas now. And then we put Detroit on the list, of course, being in the bottom of the list, as they are 38th overall. Okay, and this is among the 56 metro areas with 2021 populations of 1 million or more. Detroit came in 38th on that list. We just put Bloomberg just put them on this chart to show the difference between Detroit and some of the top ranking ones. And today, San Jose and San Francisco are the top two most affluent metropolitan areas. And that's really where the case is being made, that San Francisco is one of the most affluent areas. And so, they're not going anywhere. But I mean, I guess you could just make the same case by flipping back to this chart. In 1949, that was the story for for Detroit. Washington, D.C., third, Boston and Seattle, 4 and 5. Honolulu, Denver, San Diego, Baltimore, Minneapolis, New York, Austin, Raleigh, and Portland and Salt Lake City. I'd expect Raleigh to climb the list. We looked at some data there where, that was North Carolina was America's top business in their rankings that just came out, top business state. And it's also in the top 3 for inbound migration, according to NAR. I'd expect Raleigh and Charlotte and some of these North Carolina regions to climb the list over the coming years, because typically where people will no Atlanta. Sorry, Mike. It is shocking, actually, but I don't know what to tell you, Mike. Sorry. Blame Bloomberg. There's movies in Atlanta now. It is the Hollywood of the East Coast, and maybe they can take advantage of that actor strike, which I know absolutely nothing about and how you would take advantage of that, but maybe they could. Maybe there's an opportunity there. Okay, so I think the big thing is Detroit's products weren't positioned for tomorrow, where San Francisco's products, being in tech, are still positioned for tomorrow. We'll have to see how this plays out, obviously, and see if San Francisco will continue to keep their employees in that area, in San Francisco, Silicon Valley, and California overall, or will they, kind of go with the trend of letting people work from wherever? There's certainly going to be, a continued trend of exiting there that we've seen the last 10 years, 7.5%. Well, since 2020, 7.5% of the population has left, if those employers allow those employees to basically work from anywhere. All right, let's take a look at the 10-year. Today, it's up a tick. We're up to 3.834. Here's a look at the last 5 days. Overall trending down since we had the good inflation data of last week. We ended the week much better than the prior 3 weeks on the daily survey, according to Mortgage News Daily. We ended Friday at 6.89, so that's where we're entering the week today on the 30-year fixed. The Freddie Mac 30-year fixed weekly is up to 6.96. And we'll see where that comes in, I guess, on Thursday when that gets released again. So that's where we're at. Hopefully, we can hold firm under the 6.9 number. That would be fantastic if that was the case later on today. It'd also be fantastic if you use the code Jerome and join me in BAMX. We got a whole bunch of cool stuff going on there, the best content. But also, if you want to join me next month in August in Dallas, I'll be at the Tom Ferry Summit. So many great agents will be there. We also have a code for that. If you want the lowest summit ticket price of the year, use coupon code PRBAMSS. PRBAMSS. Okay, PRBAM SS to get the lowest ticket price to the Tom Ferry Summit on the World Wide Web. Hope you guys have a great Monday. See you back here tomorrow on the hot sheet. Until then, toodaloo.